Yeah, talking for business owners and, cash, investing and everything there and in between. I work with a lot of business owners myself, and I know you work with some business owners on your end as well, Billy. But talking a bit about like having cash, in the business versus personal accounts, like, do you have a thought on that and approach to it?
Yeah, I think, it's what you just said. Like, it really depends on the business. It depends on what your cash flow looks like, the timing of those cash flows, as you said, whether it's capital intensive or not. And of course, a lot of businesses rely on debt facilities as well. So there's no hard and fast rule for how much cash a business needs to hold. It completely depends. But I think the focus of our topic today is really on
Welcome back to the Winners Playbook. Josh here with Billy. Today we're going to be talking about business owners, and business owners often sit on big cash balances. It feels unsafe, but inflation ultimately eats it away. Today we'll show you how to pay yourself first, set a buffer for the business, and move the rest into a simple portfolio that lines up with your exit plan. But before we get into that, Billy, I'll throw it over to you, mate. What's the latest on your end? Obviously, plenty happening out there in the markets, which is keeping us busy. But what's news on your side, mate?
Yeah, I was just trying to figure out what I'm doing with my schedule and life management and my calendar and stuff. I was trying to book a client in. There was nothing there for 3 weeks.
Yeah,
and then I'm like, I don't even have my weekends, because my wife works shifts in a hospital. So between her shifts and, we're going to a wedding, we got a work trip next week. There's 8 weekends in a row where either I'm not here, she's not here, or both of us aren't here.
Chaos.
This isn't off to a good start for 2026. So I just need to reassess how I'm juggling this.
Yeah, lots happening. Well, I suppose that's lots happening in the markets at the same time. What's commodities? Honestly, gold and silver went on a huge run, and then was it last weekend they both dropped about 30% overnight, and then you had interest rates go up in Australia. Were one of the first markets to move, and then you've got an absolute bloodbath in cryptocurrency at this point in time. So what's your read on all of it, Billy? What's happening?
It's like, yeah, crypto's the interesting one out of all this, I think. Like, obviously we've seen precious metals, gold and silver, go ballistic. And these days investing, it's like, it's a real pile-in. It's like meme stocks. Like, silver's behaved like a crypto, like an altcoin. Like, everyone's piled in and the chart's just parabolic. Like, I don't think that's ever happened in silver, or certainly not for decades. Gold's gone with it. And now no one seems to care about poor old Bitcoin. It's down like 40% over the last 6 months.
Yeah.
And it's interesting because all the arguments for gold and silver, the US dollar's losing value, gold and silver's a store of wealth. Well, Bitcoin was supposed to be a store of wealth also, and that's not happening at all at the moment. So it's a good way to lose wealth. So there's some very interesting dynamics going on. And then in the stock market, last year was all about AI, right?
Yeah.
And now it's like, okay, AI might hurt software subscriptions. So now any company that's selling software subscriptions falling off a cliff, and it's all over the shop. So, what does it all come back to? It means the old school, diversification is more important than ever, because it's so hard to pick which way these things are going to go.
Yeah.
Even your Mag 7, like your big stocks in the US, they're hit and miss now too. So it's wild times in markets, but plenty of opportunities. So yeah,
it's momentum. Yeah, I think momentum's a big one there as well, because you see it all that time that people are just piling in for no better reason than that herd mentality and FOMO. And so, but it goes both ways when people start getting nervous and crypto starts dropping, just people start selling for no better reason. They don't have an investment strategy. And there's obviously a lot of leverage, which I think we have spoken about before, like in crypto. So people hold certain positions, well, in a lot of different investments as well at the same time, but particularly in crypto, like some really highly leveraged positions, and forced having to sell. So that doesn't help. That doesn't help the markets. And, but we speak about it. I think you probably looked at the last couple of times this has happened, Billy, in crypto. And every time we've seen it go down like this, eventually it's made its way back up to ridiculous all-time highs. And then you look at that graph and you zoom out and it's like, it looked like nothing does it do that again? Who knows? Does it, I think, what was it? Mike Berry, the guy that, from the Big Shore that predicted the global financial crisis. Yeah, he's come out and talking really hard on crypto as it going into like a death spiral. But, then you see people saying this and you never know, maybe they're accumulating positions at the same time. So you don't really know what to believe. It's really hard for the average person. But yeah, I guess if you hold the belief that crypto is going to be around forever and it's got a real purpose, maybe you do hold strong conviction and start nipping away at those investments or dollar cost averaging in. Certainly not saying to do that. Advisors don't even advise on it. We can't. But if you held that belief, maybe you would. But it's that whole falling knife analogy at the moment. So you don't want to go in too early and it just keeps dropping out from under you. But it does remind me in a way of the COVID crash that we had, because no one knew what the markets were doing at that point in time, how low they were going to go. That was my real first proper crash, having worked in the industry and experiencing it. I was like, how does this work? And like chatting to, likes of yourself and others who had been through like the global financial crisis. And it's like, well, no one really knows how it's going to play out. And so I was like, wow, when do I get in? When do I not? And I just bit the bullet and started chipping away, and lo and behold, nearly got the bottom of the market out of pure fluke. But I think buying into some of the companies I was buying is probably a little bit safer than buying into some of these cryptocurrencies and coins that, there's a lot of scamming out there at the same time. So yeah, interesting times, to say the least, and it definitely keeps us busy. And then you've got Australia put up interest rates, which was no shock to anyone, but not the greatest news for homeowners that thought we were on the way down in the cycle, and we sort of paused there for a little bit, and it looks like we might be on the way back up. What are your thoughts there on the interest rates? Because not everyone's a loser in there. Obviously, retirees and fixed term deposits back on the winners board there.
No, exactly. With all the market noise, it's really just going back to the fundamentals: diversification, position sizing. So you can take a nibble at Bitcoin, but you don't put 80% of your wealth in Bitcoin. You just have a little allocation there. So if you are wrong, and if it is a death spiral, that's fine. You're not going to get wiped out.
Yeah.
So you always have a few different plays going on. With property, that's interesting because in 1 week we've had rates go up. Potentially they'll go up further. And at the same time, the government's hinting they're going to have a crack at the old CGT discount in the budget that's coming up soon.
Seeing that.
So yeah, I think property investors are going to be the targets for the government this year because they never have constructive solutions to our problems in Australia. They're just going to target a group. So a lot going on in the world of investing, that's for sure. And I think we've discussed, we need to do a separate podcast on precious metals and Bitcoin and some of what's going on there.
No, for sure. And what's the lowdown high level of the CGT discount? What are they going at, getting rid of the 50%? I haven't read through it in full detail yet. What are they going at?
Yeah, I mean, we could definitely do a pod on this too because CGT is interesting. There was no CGT before 1985. Right, and now it's treated as, everyone has to pay capital gains tax. That's normal.
Yep.
Well, we never used to have it, and other countries still don't have it. Then John Howard brought in the discount, which says, if you hold an asset for more than a year, you'll only pay tax on half of your gain.
Yep.
Now that's being highlighted as one of the issues in our housing market, that it's encouraging investors to load up on too many properties and push prices up. And so now the government's talking about, instead of a 50% discount, maybe a 25% discount. That's the rumor that's going around. But I'd be pretty confident there'll be something floated in the budget that's coming up in May.
Very interesting. Well, we'll leave that one for another.
Elections have been lost before on these things, but
Yeah.
There's a lot of frustration building, obviously, with people trying to get into housing and finding it too hard. So
we'll
see.
Yeah, no, for sure. Well, let's dive into our topic then anyway, because yeah, talking for business owners and cash investing and everything there and in between. I work with a lot of business owners myself, and I know you work with some business owners on your end as well, Billy. But talking a bit about like having cash, in the business versus personal accounts. Like, do you have a thought on that, an approach to it? I've got some thoughts around, sort of depending upon the type of business that you operate. Like, do you have a really capital intensive business that does require lots of buying of stock? Like, I've got some clients in clothing and things and spending millions of dollars to purchase stock, or people running some tradies running businesses where they have to buy all the material and then they don't get paid for like 90 days on it, or manufacturers and things like that, which are quite like capital intensive. Whereas then I've also got clients that run more cash flowing businesses where they don't have any stock. Maybe they're just a consultant or HR or whatever it may be. Even like a financial services business in a way would be more along the lines of that, where you don't have to buy and outlay a large amount of money for a product, but you could be taking on debt. So it is a little bit different. But what are your thoughts around some of that, Billy?
Yeah, I mean, it's what you just said. Like, it really depends on the business. It depends on what your cash flow looks like, the timing of those cash flows, as you said, whether it's capital intensive or not. And of course, a lot of businesses rely on debt facilities as well. So there's no hard and fast rule for how much cash a business needs to hold. It completely depends. But I think the focus of our topic today is really on businesses that are holding too much cash and the cost of the cost of that.
Yeah.
Yeah. And then what we call that, we'd call it like it's lazy capital. You got opportunity cost. Like, you could be doing something more productive with that cash.
Yeah.
So I think that's where some business owners get it wrong. They're actually a bit too conservative with how much cash they're sitting on.
Mm-hmm. Yeah, and we'll talk about the options, I suppose, at one's disposal. But yeah, I think particularly for if you're not running a capital intensive business, well, then it doesn't mean you're not going to hold on to much cash. Like, you still will have expenses to pay out, whether that's your own wage and bills, or you got staff and other bits and pieces, but also just like PAYG withholding tax. Like, if you are paying staff and you're withholding the tax, which you have to do as a part of the wage, like, you don't want to spend that money because then you're going to have to pay it. So you do have to have a system in place in terms of how you're managing your cash flows, like payroll tax, biggest waste of tax around, or one of them. GST, if you're collecting GST and then you're paying some GST and doing your BAS. Company tax as well. You don't want to get caught out there. So there are a lot of things from an actual cash flow perspective where you might want to hold some cash, or as your money's flowing into your business, you bucket it away so that when those expenses are due or bills need to be paid, you're not scrambling around and you haven't spent that money. Because that's sometimes what I do see with business owners. They don't have a really clean structure on that, and then they just sort of rely on their accountants to move things around, and they can't tell me sort of where things are at and what they're doing or how they're paid and so on. So you want to get clarity around that, because I've seen some people dig themselves into some holes that are quite hard to get out of, particularly with Div 7A loans and the alike. But we're not going to go down that route, because we're going to be talking about, you've got a cash buffer in the business, and then what's those sort of priorities, or what are your options look like? Because you keep it in a cash account. What's the best you're getting these days? 4.5%, at best 5%.
Maybe climbing a bit at the moment, but still.
Yeah.
And can I say, Josh, this is something we do see very commonly. Like, so you're running a business, you're taking a lot of risk, you're investing a huge amount of time and stress, potentially a lot of pressure on your family too, right? If you've got a partner and kids, that's what it's like being a business owner. And where I think some people stuff it up is they don't, like, the business, we're not talking about startups where they haven't made any money yet and trying to raise capital and all that. I'm talking about businesses that are generating decent cash flow and profits.
Yeah.
A lot of business owners will not compensate themselves appropriately. So they'll reinvest everything in the business and not take a decent salary or dividends out for their family's benefit.
Yeah.
And that is I think that's a big issue, because if you own a business, the future is uncertain. Look at COVID. That destroyed a huge amount of businesses. And we have rising interest rates and inflation that can destroy businesses. So if times are good and the business is going well and the cash flow is there, you need to compensate yourself and de-risk your family over time. So not have your entire future riding on the business. I think that's like one of the main points here about hoarding cash in a business. Sometimes you just need to get some of it out.
Yeah, diversify. It goes back to the point you said earlier.
Yeah.
It's like, how do you sort of alleviate the stresses around everything that's going on in the market, where you just don't have all of your assets in, all of your eggs in one basket, all of it in. But that's the reality for a lot of business owners. A lot of the business owners, their biggest asset is their business. But what you see the smart ones doing, once they get through the stage and they're actually surviving and they're getting more into the thriving, and like you said, they're cash flowing, well, taking some money out of the business, doing it in a tax effective manner, and then starting to scale up other passive income streams, because ultimately you probably don't or may not want to have that business going forever and be at the helm of it, and you might end up selling it down the line, which we'll touch on as well. And that's where you got to look at your alternatives. And if we then start looking at what those alternatives are, or the priorities, you're generally going to have debt or a home that you might live in at that point in time. You've got super, you can invest. Do you have a cash buffer? Where do you start putting that money? How would you say, like, say you've got a business owner, Billy, like they're quite comfortable, paying out strong wages to themselves, maybe got over $500,000 floating around in the business, they don't need it, they can look at doing something with it. What would the priorities look like? They've got a mortgage, got some super, probably haven't paid a huge amount of super over the years. How would you start approaching that?
Yeah, what are the priorities? Well, obviously you need the cash buffer. So if we're talking about someone who already does have a substantial cash buffer, if it's all in the business, then we need to look at getting that out of the business and separating. Like from an asset protection perspective, if the business is sitting on more cash than it needs, you're often better off getting that out of the business and into a different ownership structure, so that cash is not at risk.
Yeah.
Once you've figured out how to do that, whether it's via salary, dividends, whatever it might be, what do you then do with that cash? The main thing, again, if you've got a partner, asset protection is key. So if you're a director of a business, if you're then investing personally, you don't want those investments in your name as being a director of a company. So ownership structure is then the next thing to look at. Then the last thing is what you're actually investing in, right? And it's property, stocks, super. They're all good options.
Yeah.
But I'd say the asset protection and the ownership structure is probably the first thing to figure out.
Yeah, first major step, and then like you said, you've got it out, you've got the right structures there, and then it's around what do you do? And I think it really comes down to like the stage of life that you're in, and that generally is gonna most of the time dictate how aggressive you go with your investing. So if you're in your 20s, 30s, or maybe even 40s, like you're probably gonna have and should have a higher risk appetite generally if you're gonna be investing in the right things longer term. Whereas if you're at the back end of your business journey and you're in your 50s or your late 50s, you're probably not going to have or should have the same risk appetite as someone who's a hell of a lot younger than you. And that's where you might be considering, debt reduction might be a lot more on the radar in those later years. If you're a bit older, you might be starting to chip down on that debt if you haven't before, because you've just been in accumulation phase and accumulating properties, building up your share portfolio, your investment portfolio, whatever it may be, commercial, residential property, etc. So that you're in that accumulation phase. But then at some point in time, you are going to have to do something about the debt. And that's where you might look at starting to trim down on some assets at some point in time, or maybe just with your regular cash flow, you just start really smashing down on your debt at that stage. It all comes down to obviously having a plan. But a lot of what I also see as well is business owners, and if we just touch on super, which was a part we're going to touch on a little bit later, like I do see a lot of business owners do tend to neglect superannuation, because at the beginning, when you're sort of starting out, you're not really paying yourself anything, and then you get to the stage you start paying yourself something, but then because you're a business owner, you can sort of choose in a way how you pay yourself and how you take money out of the business, and therefore you don't have to pay yourself any superannuation. And some business owners do that because they go, well, if I'm in my 20s, 30s, 40s, why would I put more money to my superannuation, and I can't touch it till I'm 60, and who knows what the government does between now and then. And I see that thought a lot. But if you have a business owner, Billy, what's your view around them in superannuation, and how do you approach it?
Well, okay, there's pros and cons here. So the pros are super's the best place from a tax perspective by far to build wealth in Australia. And it's excellent from an asset protection perspective as well. Generally speaking, if you're going through some sort of debt, bankruptcy or something like that, super's generally protected. So asset protection and tax, amazing. Investment choice, great. You can invest in almost anything through super. A lot of people don't know that too. You can go self-managed if you want to have more control.
Yep.
The only downside is the lock-up period, right? It's locked up till 60. But if you have a partner, there's a very, very good chance at least one of you is going to live past 90. So to just completely neglect it because, I can't touch it till 60, what's the point? So you're going to pay a lot less tax over the journey. The money's protected. You can invest it however you like. And then it means post 60, you're going to have this huge asset you've got access to.
Yeah.
So very, very silly to ignore it. Not to mention it'll save you tax now, right? You can put money in on a pre-tax basis. So the guidance is, again, we're not talking about businesses that are in startup mode and cash flow is super tight. We're talking about businesses that are a bit more mature. If the cash flow is there, you're barely going to notice if you send 30 grand a year pre-tax into super each year.
Yep.
But to do that for 20 or 30 years, that's a huge, huge amount of money asset you're going to have access to down the track.
Well, it's a bit like a backup plan in a way, because you've got all your eggs.
Ultimate backup plan, yeah.
Yeah, and it's the ultimate backup plan, which is the most tax efficient. And I was just going to pull up our good friend calculator, the compound interest calculator.
Yeah,
and if we go, what did we say, $30,000? Obviously, there's going to be a bit of tax on that, but just for simplicity, we go $30,000 a year over a good 20 years, and we'll grow that at 8% a year return. So 30,000 a year over 20 years. There's about 1.4 million. And if you stretch that out over a 30-year period of time, we go from 1.4 million to 3.4 million. So,
numbers are crazy. And this is a separate podcast, but for business owners, you can put property in there too. You can buy business premises. You can buy a factory or a warehouse or something with using your super. So it can actually help your business too in some situations.
And that's what I've been speaking to a couple of clients I've got of mine lately who are a little bit younger. And I'm like, okay, tend to, again, agree with the view that super's a long way away. Just hold on to as much cash as we can, invest it elsewhere. But then, if they've got let's just make up a scenario, someone's running a business, they, run out of factory, they store goods, clothing, whatever it may be. And it may make sense to start building up superannuation and get to the point where there's enough of a balance there where you can purchase a commercial asset, being a factory, warehouse in the situation that I'm referring to. And then you buy that through your superannuation fund and then you lease it back to your business. So a very, very common for business owners to do that. And you can actually get some really good returns out of commercial assets at the same time. I think you don't want to do it just for the sake of buying a property for your business. Like, it still has to be a good investment decision, most importantly.
Yeah.
It has to stack up because, that's the whole purpose of superannuation is that it's there for your retirement. So if you're buying an asset and it's a bit of a dud, that doesn't really help anyone at all. But very, very common for business owners to consider that. And again, if we talk down the line, superannuation is Australia's tax haven. You could sell that asset possibly tax free, no strings attached after age 60, if depending on the balance or the value of your superannuation at that point in time or the value of the asset, you could actually sell it tax free as per how the rules currently stand after age 60 if you retire or you meet various different conditions. So it can be incredibly, incredibly powerful. And we talked about, Billy, the other week around that sort of arbitrage of where, business owners paying out money to themselves and then investing it, or paying it out to a bucket company through their trust and only getting taxed at 30% instead of 47%. Well, when you take into account superannuation, like that 30K that goes in only gets taxed at 15%. So you've got more money left over that can then invest and can go harder over a longer period of time. So you definitely don't want to sleep on it, because the problem that we've spoken about before, and I've got some clients I'm working with at the moment, is if you save, you run too late. We were having a conversation with some clients earlier this week, Billy, on this. If you save, you run too late on getting money into superannuation, you won't be able to get it in because there's an age limit to when it cuts off till you can get money into superannuation, and you can only put a certain amount of money into super every single year. So you might go, well, I've got $1 million. I want to get that into my super. It's like, well, no, on an individual basis, you can only get 360,000 in one hit, and that drops out your ability to contribute for another couple of financial years. And probably a podcast topic for another time as well is like talking about for business owners. If you do sell your business at some point in time, there are different exemptions and rules that apply to you, which can allow you to actually get more money into superannuation and give you various tax breaks at the same time. So that's probably one to get an accountant on for, I think, actually, because it's a lot of it would be definitely an unknown for a lot of business owners out there. But yeah, any other points on that, Billy, before we move on from there?
Yeah, so we've covered super well, but in terms of investing outside of super for business owners, as you just mentioned, an investment company can work well. So again, it's ticking the box of asset protection. And then in terms of tax, you've got a 30% tax rate. And it'll be interesting to see this CGT stuff with the government, because if they cut the discount, that actually makes a company look even more attractive, because there's been criticisms that, you don't want to invest in a company because you don't get the CGT discount.
Very much.
Well, CGT discount's under attack at the moment. So maybe those investment companies might become a lot more popular in the near future.
Yeah, no, it's a really good point. I hadn't thought of that one, and that's really what happens, Billy. Like they make one rule change, and then people will just pivot more to something, to something else, and it will definitely make investment bonds more attractive at the same time, because the same tax rate of the investment company at 30%. So you're just going to get people with more money just pushing it to other vehicles, basically.
And so we tell clients, because some clients get quite paranoid about governments changing rules.
Yeah,
like they're always going to change the rules. You're always going to pay tax.
Yeah.
You just change your strategy. Like,
yeah,
it's Australia. You're going to pay tax no matter what you do.
Yeah.
It's just being aware of the rules and responding to any changes.
Yeah, you just got to flow with it. What is that Bruce Lee quote? Is be like water, be like water, and you just got to go with it. And I think if that happens, then we'll just naturally adjust with our clients thereafter. So I think that's a really good point, Billy. And what about building an investment policy for owners, so we're just not acting on an ad hoc basis? What are your thoughts around that one and the approach?
Well, at the risk of talking up our own profession, most business owners, if they've got a decent amount of cash flow and a decent amount of assets built up, they need to do it with an advisor's guidance, because your best, where do you want to spend your time and energy? I'd argue it's running your business, and then in your free time being with your family or people you're close to, not sitting down working on financial plans and investment strategies. So get some professional guidance. It's going to be worth paying for. But what you want, like in terms of where to invest and a strategy around that, you don't want it to consume too much time and energy. You don't want to be monitoring things daily. You want to set out a strategy that's covering investing in super, maybe investing through a trust or a company. What assets we're investing in. It's usually some combination of property and shares. And then you want it to be largely low maintenance after that. So built in as part of a cash flow plan, money's automatically going into those different buckets and just building up those assets, building up the assets over time. Then you do a formal review of that once or twice a year.
Yeah. Yeah, I think that's like perfect, great way to approach it. And it's something I talk so much with, clients, not even just business owners, is what's the value of your time? And if you're a high income earner or you're a business owner, do you want to spend hours and hours and hours busting your brain, figuring out what to do with your money? Emotion gets really tied up involved in it, incredibly hard to be objective on your own position. So, that hasn't really, been good in the way of building your own business, but it's not very likely that you're going to be as successful on the other side of things. And if you start spending or taking your time away from the business and pouring that into building your own sort of financial plan, and that could actually hurt you on the business side of things as well. So, very, very much a big believer of outsourcing things that aren't in your wheelhouse. And, a lot of advisors as well will get you exposure to things that you probably never would have known about yourself, or you might not even be able to get exposure to yourself because you don't have the right connections or relationships or just certain investments would never cross your radar. And it actually, I was listening to a podcast earlier this week, Billy, the one, have you gotten through it with Tony Robbins and Alex Hormozi?
Yeah, great one.
Yeah, it was. I'm actually really listening to it. It was a really, really good one. And there was a part at the end, I think, where Tony Robbins was talking about the average returns of private equity over a longer period of time, and say, historically, share market, what does it give you? 9-10%, maybe a bit more based upon the US returns. But then the average private equity fund, I think, over that 20 or 30 year time frame was about 15%, and some of the top tier ones were like 20 and beyond, I think he was saying. And so you look at that difference of return, and I've still got that compound interest calculator in front of me here. If you go an 8% return on the 30K per year over 30 years, that was what figure do we have before? 3.4 million. If we just make that 15%, we go from 3.4 million.
The calculator, I think.
Mind blowing, $13 million. So that's where it really, really does come down to the fact of, sure, you could take your money, not get any advice, and you could just whack it in a high growth index, collect 8 or 9%, probably longer term. Okay, but if there are better ways of doing it where you can achieve these higher rates of return, that's generally where you're going to be getting an advisor involved who can give you access to some of these options or keep you informed to when they may come up. But I love that podcast, and it was a really cool part at the end hearing Tony actually talk about that.
Yeah, that's awesome. I have to read his finance books now.
Yeah, well, it's in the have you read his main one?
No.
What's his money one? I read that quite some time ago. It's in the boardroom, Billy. You can pick it up. It's in the boardroom, up on the shelf. Yeah, mate. Go grab it for a little bit of reading. It's probably due for a reread for me actually as well. That's
I think the other thing here is risk profile, which is a term we have to use a lot in our job. But a lot of business owners have they think they have a high risk tolerance, right? Because they're running a business. It's risky, it's stressful, it's hard work. It can blow up, and it's high risk. And so when they look at investing, there'll often be an attitude of, oh, why would I try and get 8 or 9% a year? If I invest in my business, I can get 20 or 30%.
Yeah.
It's like, it's a different degree of risk. Right.
Exactly.
And the 8 or 9% can be very low effort. With your personal investing, that should be low effort, relatively low risk, set and forget. And importantly, de-risking your life and your family's life, because now you don't have your entire future riding on this big business exit in the future.
Well, it leads into one of the final points we're going to touch on is, like, at some point you are going to be exiting out of a business, and hence why you want to build up those other streams. But if you're exiting over a short period of time, say 2 or 5 years, would you approach the investing differently in that sort of a situation?
Yeah, it's like with all investing, it's about timeframes. I think if you're looking at a big business exit with a big payout, if it's sort of like, if that's leading you into going from into some sort of retirement, I guess, or like working less, let's say, and earning less, then I would see it as going from wealth accumulation phase to passive income phase. So if you're aligning your investing with an exit, it might be when the exit happens, debts are going to be cleared, super's going to be topped up, investment portfolios are going to be topped up, and we're now going to have a lot of passive income available.
Yeah.
Yeah. Whereas if you're investing and there is no business exit, like you're early on in your business journey, that's a very long time frame. So it's just about, automating your investment strategy and building up your assets. It's accumulation phase.
Yeah, no, for sure. And if you are, exiting a 2 or 5 year time horizon, you might actually be operating out of your business a little bit differently and keeping things quite clean, maybe not taking out money from the business, so to speak, or doing certain things because you're actually building it to sell it at some point in time. So I think what you're doing from an investment point of view over a period of time like that, if that is the end goal, then it may look a little bit different. But what about in closing, Billy, like reporting rhythm that keeps you honest without drowning in spreadsheets? I might just say, like, what we do as a business is something that we've adopted recently through, and I think I've mentioned it on the podcast before, reading of the book Traction and the EOS operating system, which I know a heap of business owners sort of operate their business through that model. And so, you have a cadence to when you're catching up with your senior leadership team, you agree upon what your 10-year vision is, like what's that BHAG, that big, scary, audacious goal for the future. Okay, cool. There's a North Star. Then you reverse that back to the 3-year goal, the 1-year goal, 90 days. And that's where you have your like quarterly cadence, where you have your quarterly leadership team meeting, you go through your numbers. So looking at your numbers and understanding that. So we're accountable. So it's like, okay, in 12 months time, if this is where we want to be, this is what every department needs to be doing. It's just really clean and measurable. So that one for us as a business has been awesome to start adopting that. I know there are different versions of it as well, but I do see a lot of business owners using that. Some other points I thought would be worthy of mentioning, like having a coach or consultant is really good. Like we've been working with consultants for quite some time over the last 3 to 5 years, and we still are. You might have different consultants along the journey. We can't forget the good old accountants, having a good accountant who works with you that knows their numbers. A lot of accountants might, catch up with you on a monthly or quarterly basis as well to run through your numbers. I do see some clients do that with their accountant, and then the accountant's, organizing their balance sheet, profit and loss, and goes through it every month and tells them what's happening. That can be a good option, just depending on, again, I suppose what sort of business that you're trying to operate. But I think it boils down to as well of also just you should know your figures to an extent. Like you don't need to know all of the ins and outs, but you should keep an eye on your P&L and ideally maybe check it every month. I guess it depends upon the type of business you run and is there seasonality in your revenues and your cash flow coming in, but having an eye on your P&L and knowing some of your figures high level. And then of course you have your professionals around you that's going to, get right into the nitty gritty with you. But that's, I think, a good way of approaching it is having a good system, a cadence with the catch ups with your key team members, quarterly look at those figures, how are we tracking on how we should be. I think that's a real good way of approaching it. Have you seen anything different, Billy, or anything that you're familiar with?
No, I'm just aware that a lot of businesses don't have that, right? Don't have that sort of structure in place.
Yeah.
A lot of it comes back to a good team, right? Not having one person trying to manage this. So having a good team, having that regular rhythm in the calendar, having some accountability. The EOS system's awesome for that. So yeah, you've covered it pretty well.
Yeah, I'd strongly encourage any business owner to read that book, Traction, and have a check it out. It's been awesome for us, but I know it's also hard for a lot of business owners when they're just starting out because it's kind of like they do everything. Their sales, their marketing, their accounts, their probably reception, admin, whatever it may be. But it's a different kettle of fish, that one. But if you're a more established business, having that sort of operating rhythm and structure, I think is absolutely critical. So in closing, Billy, any points that we haven't touched on, or any other important points you had noted down?
No other points here, but we are going to be covering this topic a little bit more. We had a recent pod recording with Baz Gardner, so anyone who's listened to this, strongly urge you to listen to that one as well. We'll definitely have some more targeted discussions around this area. So,
has that one gone out on the? Has that been released yet, or is that next week?
I reckon it's next week.
I'll have to listen back to that one because I was over in Perth at that point in time. So I'll be very much looking forward to that because Baz is a genius in some of the work that he does around some of that. So I'm very much looking forward to it, Billy. And next week we're obviously off to Philippines. So we'll be off over there for a week with the conference with our team in Lavera. So we've got a good week over in Philippines, putting on our first conference. I think we're going to have about 130 people there. Which is
how did we get to 130? I thought, how many do we have in Lavera? So that's about 90 or 70.
Got about 90 over there. So there's about 90 over there, and there's obviously a good cohort of us coming from the businesses in Link Wealth, and then I think there's a big chunk of externals, sponsors, some externals coming in there, and so it's going to be good. So there's a lot of integration between the teams, getting into the culture. And then we've got some big speakers that are going to be coming in for some sessions at the same time. And so it's our good first crack at running a conference. And I reckon the next one we run will be a lot bigger and better and a lot. I think this is going to be a good test case, and then we'll see what we can do for the next one. So nevertheless, still a lot of pressure on for this first one, and there's going to be a few people, so we have to deliver.
And have you stayed at that resort before?
No. I haven't. I haven't fully looked at it either, but I know it's going to be hot. and there'll be a lot of sweating involved. I do know that. I can guarantee you that one for sure. But I think we've got some good water activities and things like that planned. The team behind the scenes have been working incredibly hard to get this organised. So it should be good, and very much looking forward to it. And we'll look forward to getting back on the podcast once we return. But until then, I hope you guys are getting value out of it. If you ever want to chat with any of the advisors, always go to the website. You can take a pick from any of the advisors, or check out our accounting business or our finance business if you need. But until next time, we'll see you then, and take care, Billy.
Thanks, Josh.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.